Hello everyone and welcome to another one of my investing videos where I try to simplify aspects of the markets and how they work. I would like to remind you that I am not a financial advisor. Anything I say here is for education and entertainment purposes only. You can and will lose money if you don't do your own research. Risk management. What is it and how do we use it? Risk management is not used to make money, rather it is used to prevent or control losses. And before we dive deep into the need for risk management, it's important to note why it's so important to educate ourselves on proper risk management. A simple Google search can give you lots of pretty pictures and graphs illustrating the risks associated with investing. But one of the biggest concepts is percentage loss and the amount needed to recover from that loss. Let's suppose you have an account with a value of $1,000 and you take a loss of $200 on that trade. Well, you just took a 20% loss in your portfolio. So you're thinking, okay, I just need to make up 20% profit on my next trade to recover my losses, right? Sorry, but that is wrong because after your initial loss, your account is now left with $800 and a 20% gain on that account would be $160, not the $200 that you originally lost. You would need to make a 25% profit just to recover from your previous loss and break even. To better illustrate this, I have this lovely graph that shows the gain that is required on the account in order to recover from a specific loss. And as you can see, the values get less and less proportional as the percentage of loss increases. This is also why you almost always hear experienced traders say that you should not risk more than 1 or 2% of your account on a particular trade, because small losses are easier to recover from than a massive loss from poor risk management. If you prefer to see it in table format, you can use this table, or if you have a particular loss that's not on the graph or table, you can use this equation to determine the amount needed to recover from a specific loss. Here are a few examples of how it would work. Okay, so risk in investments is seen as an outcome that is different from what is expected. For example, you might expect the company's share price to go up, but it goes down, or vice versa. In the investing world, it is considered part of doing business. That does not mean you can't do anything about it, like risk mitigation or protecting your account from certain risks. And there are several types of risks in investing. Some are systemic and affect the overall markets. They're usually based on market volatility and are assessed by comparing an investment to a popular index, sometimes referred to as beta. And then there are specific risks that only affect a particular sector, industry, or company, such as earnings or a news event. Risks can also be attributed to macroeconomic events such as inflation, taxes, interest rates, or global policy. Then you can have microeconomic events that are due to the performance of a sector, industry, or company. Even foreign events such as shifts in the global currencies and economies, foreign conflicts, or specific treaties or pacts can influence the movement of the stock market. But those are all risks that the average trader has little to no influence over, but they are still important to monitor. So what are the risks that a trader can have some control over? That is the risk that a trader poses to himself. Traders will sometimes take large losses because they are not educated or well prepared. They need to have a well thought out strategy before entering a trade. If they don't have one, they are exposing themselves to serious risks that can crush their accounts. Some of the risks that traders will pose to themselves are due to the failure to identify the type of trade they are entering, the volatility in the current market, sector, industry, or company's share price, the current market trend, a good entry, profit, and stop loss zone, use of proper position sizing, emotional control, or even being aware of the number of open positions at any given time. All these factors and proper understanding or lack of understanding can have a significant impact on a trader's account performance. Knowing which type of trade to enter and sticking to that decision is paramount. Day trading is considered by many to be the riskiest of trading styles, followed by swing trading and finally long-term investing. The majority of risks I cover in this video will apply mostly to the first two types of traders. Because history has shown us that if a company is fundamentally sound, improving and growing, then its share price will have a high likelihood in appreciating over time. These are generally the type of investments long-term investors put their money into. But sometimes new traders will confuse the difference between a fundamentally sound company and a short-term momentum stock. It's important for traders to stick to a strategy and know what type of trade they're going to enter. Inexperienced traders that have not done a complete analysis of a company and its fundamentals and enter day trade because they believe the momentum is strong, and then the company's share price does not perform as expected, will sometimes stay in a trade way longer than anticipated, sometimes for days, weeks, or months in hopes that the share price will recover, often leaving them with significant losses or what is commonly referred to as bag holding. A trader's trading style and confidence can greatly influence the type of trade they will enter and their portfolio's diversification, and they will help form what is known as a trader's identity. I like the 60-30-10 portfolio diversification approach in bull markets, where 60% is placed in long-term investments, 30% is used for day trading and swing trading, and I use the proceeds from those trades to add to my long-term investments. Then the last 10% is used to invest in speculative markets and assets. Regardless of how a portfolio is managed, it is still prudent to be able to adjust a portfolio based on market conditions. Market volatility is hands down a critical aspect to risk management. It influences almost all aspects of a trade, from the entry point to the take profit and stop loss placement. Market volatility is simply put the range a particular asset has moved within the highs and lows during a specific time. Some assets have higher volatility than others. For example, here you can see on the left that AT&T had a range of about $2 in the last 10 trading days, and on the right, Tesla's share price had a range of about $225 for the same time period. Experienced traders would not use the same strategy for both companies. Not being aware of the current trend also poses significant risk. For example, here we see on the 5-minute chart that this company's share price is on a downtrend, and maybe taking a short position on this company might not seem so bad. But zooming out to the daily time frame, we can see that it is just a pullback from a bigger trend, which happens to be part of a longer bullish trend on the weekly time frame. Taking a short position on this company does not seem as appealing as it did from the 5-minute time frame. Using multiple timeframes can help give a better perspective on whether a long or short position is justified. A big part of why traders tend to lose money is because they struggle to know when to enter or exit a trade. Some get FOMO and chase after what they believe is a winning trade. Some will buy with conviction but will sell too early for small gains once they start to see red in the market and won't let the trade play out to its full potential. And others, as I mentioned earlier, will hold on to a losing trade way too long and are left holding the bag. A lot of this has to do with lack of trading time in the market or insufficient knowledge of basic technical analysis. Learning the basics of support and resistance levels along with some basic technical charting and indicators can help improve the placement of entry and exit points. For example, looking at this chart, we can see that the support and resistance levels are approximately here. Now, adding a few leading and lagging indicators, we can start to get a better sense of where price might be heading and what potential areas could present the best risk to reward. Suppose a trader feels they have mastered technical analysis and is very confident that the share price will be going up soon for a particular company's share price. Now, suppose that the share price does not act as expected and it begins to move in the opposite direction. Where does this trader call it quits and accept that the analysis was wrong? Knowing when to get out is often more important than knowing when to get in. Identifying a location on a chart where if price were to reach that location, it would indicate a change in trend and subsequently a proper place to exit is vital to keeping losses to a minimum. When formulating a trading strategy, most traders will already have this location identified and they place their stop loss at or just below that point. For example, here we can see that price has held as support along these trend lines several times in the past. And if price were to fall and break below these trend lines, it could cause a lot of traders to sell out of their positions in order to minimize losses, further adding to the selling pressure and drive the price even lower. Placing a stop loss just below or at this location can help a trader exit a position before the price crashes down to a point where they would suffer devastating losses. Some use mental stop losses, others use hard stop losses. Either is fine if the trader sticks to the strategy. Adjusting the stop loss lower because price is going down defeats the purpose of risk management and further increases losses of what could have originally only been a small, negligible loss on the account. Fear trading is all too common and a large reason why some traders destroy their accounts. Not all trades will be winners. We all have red days. The key point is to identify when we are wrong and minimize the loss. Remember, taking a small loss is easier to recover from than taking a big loss. Another helpful tool is the use of step, tier, or split entries. This is where someone sizes in with a small amount into a position they like to get in but are not 100% sure if it's the best entry point, but don't want to sit on the sidelines in case they are right, then enter a full-size position once their hunch is confirmed. Or when they start to take small amounts of profit on the way up as the share price is rallying up. This can alleviate some of the pressure to try and sell when the share price pulls back, which can cause an inexperienced trader to sell out of their position out of fear that they were wrong. Being able to identify an entry, profit, and stop loss location is great, but it is also important to assess if the risk to reward makes sense. This is a common risk to reward matrix table. It compares the risk to reward used to a specific win rate. You can see that traders that have a poor win rate and low risk to reward, considered to be anything below 50% and 1-to-1, which account for the majority of new traders, tend to have unprofitable portfolios. There are many reasons for this. I've noticed that this is usually a result of people taking profits too early, or holding on to losers that were never meant to be long-term holds. I also noticed that it is also related to traders not knowing where the entry, exit, and stop loss locations should be, and they enter at the wrong spot most of the time. The best way to improve win rate without the potential to lose money is to use a trading simulator. There, a trader can practice and see what strategy works best in certain sectors or asset classes. They can backtest and hone their risk to reward profiles in order to train their mental trading muscles. Some prefer the 1-2 method and aim for a win rate of 50% or higher. Keep in mind that targeting a larger reward makes it harder to achieve a high win rate. Setting realistic goals is key. Practice and experience is paramount. That's why a trading simulator is the best tool for beginners. Volatility, trend, and chart structure will play a big role on the reward to risk being used. For example, here in this chart, we can see that the price is in a downtrend. The highs are here and the lows are here. And suppose a trader is only interested in taking a 1-3 risk to reward trade. A good short entry would be near the top of this trend line, and a stop loss above the previous high would be a good placement. However, trying to enter a risk to reward of 1-3 would not make sense. We can see that when price hits the lower trend line, it would be a good place to start taking profits. This provides a risk to reward of 1-2. A good trader would need to consider if it is worth the time and effort to try and get into this trade, or if it's better to look at other charts that provide a higher probability of success for a 1-3 risk to reward. Almost everyone in the investing world knows the phrase buy low, sell high, but no one knows where the low is. Anyone that says they know where it will be is probably lying, unless they are referring to the value of 0. The best anyone can do is use statistics and past data to try and find a buy or sell zone that provides a high probability of success for their trading plan, and be prepared to get out of with small losses if their trading plan does not work. Also know that a win-loss ratio less than 1 is not good. The win-loss ratio is the sum of winning trades divided by the sum of losing trades. For example, if a trader has 10 trades and 6 trades are winners and 4 are losers, the win rate is 60%. And suppose the trader used the risk to reward ratio of 1-2 on all the trades. Well, the risk to reward matrix shows that the trader should be profitable. But the truth is that the total of the 6 trades only netted the trader $300, and the total of the losing trades netted a loss of $320. This would give the trader a win-loss ratio of 0.94, meaning the account is net negative. A way to mitigate this is to have a dynamic position size and have a set risk value. A huge mistake traders make, and I was guilty of this when I first started, was averaging down to try and break even because they think the stock will rally and they will make more money. This is a great strategy for long-term portfolio, but a horrible one for anyone day trading or short-term swing trading. As a person begins to average down, they also begin to increase their risk and potential losses. For example, suppose a person buys 10 shares of company XYZ. They pay $5 per share. But the share price goes down to $4.50, that's a loss of $5. So they try to average down and buy 20 more shares, so their new cost basis is $4.66. Seems cool, it's only 16 cents away from the current price, and they're still down only $5. But the share price goes down to $4.40, so they average down with 20 more shares. And the price goes down again, and they average down again, and they repeat this until the price reaches $4 per share. Here we can see that the total loss from averaging down is much greater than if the person had just held onto the original 10 shares. This brings us to the topic of how to get a good position size. Using the mentality of buying X amount of shares for all positions is not a practical approach. Share prices vary and so should the position size. For example, buying 100 shares of Tesla is about $87,000, but buying 100 shares of Visa is only about $20,000. For most new traders, buying 100 shares of either would require a large portion, if not all of their portfolios. The preferred position size is related to the number of shares or percent of an account a trader uses compared to the size of the account. It is common for traders to take only a position size of 5 to 10% of the portfolio and risk no more than 10% of that amount on a trade, or to have a fixed dollar amount to risk per trade. For example, if a portfolio has $100,000 and someone decides to enter a trade, they will use 10% of that, or $10,000 for the position, but risk no more than 10% of that, which is $1,000, which is equal to about 1% of the total portfolio's value. So how do we calculate the number of shares to purchase? There's several ways to do it, but a quick and simple way is like this. Suppose an account has $10,000 in it. The trader does not want to risk more than $100. Now let's suppose that the company's share price is trading at $20 per share and the stop loss will be at $18 per share. In order to determine the number of shares to purchase, simply divide the amount that's being risked, in this case $100, and divide it by the difference between the entry point share price and the stop loss share price. leaving us with an entry of 50 shares at the $20 share price with a stop loss at the $18 share price. Another method used by traders is the Kelly formula, but I find it sometimes will indicate a larger percent of investment than I'm comfortable with. And then there are others that use the portfolio return formula to try and balance out their portfolios. No matter what formula, strategy, or method is being used, a trader won't be able to see significant returns until they can master their emotions. A trader that trades with fear of losses, FOMO, or euphoria will most likely make mistakes. Some will chase a trade buying near the highs. Others that have taken big losses in the past will sell out as soon as they see a little profit. Some will not stick to their trading plan and move their stop loss multiple times, adding to the losses and possibly leading to a big bag holding situation. Some will enter a position just to be in a position even if there are no clear opportunities in the market. Then there are traders that are losing sleep or constantly checking their accounts. This lack of discipline is dangerous for a portfolio. This could be because the position size is too big or they're using the wrong risk to reward. When traders find themselves in these types of situations, it is best sometimes to take a step back and use a trading simulator. Study the markets, backtest some strategies, and generally reset the mental state in order to strengthen the emotional control for when they return to live trading. A trader should be aware of how many open positions they have at any given time. This will let them know how much of their account is at risk at any given time. This generally applies to short-term investing. Long-term investing is different, in that it is believed that the more someone diversifies, the better their portfolio will perform. Without a proper trading plan, traders are just gambling. It is important to create a trading plan before each trade is made. A trader should know the type of trade being made, the entry, take profit, stop loss, risk reward being used. They should understand what price action is doing, what the indicators they are using is telling them, and what trend is currently being traded. Markets, sectors, industries, and companies are different. Therefore, having multiple trading strategies is ideal. This allows for flexibility and adaptation to the changing environment in the markets. A few key questions traders should ask themselves before buying or selling anything are: what am I trying to do? What can affect my position? Of those things that can affect me, which are more important? Once those questions are answered, then a trader can begin to set up a trading plan or walk away from trading for the day. If they enter a trade, they should ask, did it work? Then document anything that affected the trade or changed the way that the trader felt about the particular trade. Social media is a great place to get educated and become well informed. But be aware that there are people on YouTube and other social media platforms that are mainly trying to convince you to buy a particular stock or buy into their special trading course for their own benefit and do not care if you succeed or fail. A large percent of them are not financial advisors. They will try to amaze you with their crazy P&L figures or large accounts. Just remember that their trading style might not suit your trading style. And others are just promoting a company they already own and want to pump it before they can dump it on their followers. And some make money from other ventures and make it appear as if it comes from trading in the stock market. If someone on social media recommends you buy or sell anything, do your own research before risking your own money. If you found this information helpful and would like to see more videos like this or get notified when I release new videos, click the like, subscribe, and notification buttons. Leave a comment below if you would like to see a video on a specific topic. Thank you for watching and have a great trading week.